I think we are live. Looks like we're live. We'll wait a few minutes. We'll let you guys check in. How are you doing this afternoon, Clarissa?
I am great. How are you?
I am fantastic. It's Wednesday already. This month seems to be flying. And
I know it's been crazy month. The whole year has been crazy.
yeah, we're already into May. That's pretty scary if you're waiting to do something. Might be better just go ahead and doing it instead of waiting. But for those of you who do not know me, my name is Danny Bullock, and I am a life-centered planner with Dream Builders Financial Services. And I have on the call today my assistant, Clarissa. She'll be helping me out a little bit. And we're going to get started in just 1 minute. So I am going to share my screen so we can get set up and get ready to go. All right, so I, again, am Danny Bullock, like I said, and today we're going to be talking about Social Security, and Clarissa is on to assist me with any information or any questions you guys may put into the chat. If I did try to do all of that, this would be a pretty bad presentation, and so she's going to help me out a little bit with that. So want to thank you guys for coming, and like I said, we're going to talk about Social Security in this short, I'm going to try to keep it 35 minutes presentation, just focusing on the basic rules and strategies so you can find out information on only what you need to know and no more. Social Security, to some degree, I like to say it's an individual sport. So the questions you're going to have are going to be unique to yourself. So if you have a question, just a basic housekeeping rule, you can put the question in the chat and I'll try to get to it at the end. If it is for your specific situation, the best thing to do is Clarissa will be putting a link to my calendar in the chat as well. If you want to set up a 15-minute discussion with me about your particular situation, it might be better for me to answer questions a little bit more directly there, but I may also end up answering your questions as I go through the presentation in itself. But if you have any questions or anything like that about anything I discuss, write it down. And then if you want to meet later, we can discuss those things then. So let's get started. As usual, this is only intended for education purposes only. This does not constitute tax or legal advice. In the event that you have any tax or legal questions, please seek out a tax professional or a legal professional for specific advice. This is just a presentation for education rules only, or educational means only. All right, so first basic rule of Social Security, which is one of the most important things that I think people need to understand, is your benefits will your monthly benefits will raise with claiming age. In other words, the longer you wait to claim your Social Security, the higher your benefit will be. Now, to illustrate this, I need to give you guys a little bit of background. Now, bear with me, I'm going to go through just some acronyms and some definitions so you can get the full picture. So we'll start with the primary insurance amount, or the PIA. It's calculated at age 62 based on your highest 35 years of earning. It's the amount you will receive if you file for Social Security at your full retirement age, which I'll talk about next. During this presentation, I won't be talking about how the PIA is calculated, but it's important to know that it's based on your earnings history. If you earn the Social Security maximum every year for 35 years, you would qualify for the maximum PIA, which is $3,262 for those who would be turning 62 this year. If you work less than 35 years or you had several low earning years, they would take an average of what those years are, and that's how they would come up with your monthly benefit. But our focus here today is on claiming age, so let's just keep going. All right, so another definition you need to understand is the full retirement age. This is not necessarily the age you plan to retire, but rather the age at which you claim full unreduced security benefits. This used to be 65 for everybody. Now the age is higher, being they're phasing in months to certain ages based on the amendment back in 1983. So if you were born between 1943 and 1954, your full retirement age is 66. For everyone born like me and Clarissa after 1960, our full retirement age is 67. But for those born between the years of 1955 through 59, your full retirement age is 66 plus some months. And what I do honestly believe is as we keep going into Social Security to keep it going, they're probably going to start adding months to our age too. So I wouldn't be surprised in the next 5 to 10 years if they added, born between 1960 and 1975, 66 and 4 months, that sort of thing, to delay the time you're able to pull the money out to allow more benefits to go in. So I'll give you a second. I'll give you a second to take a look at that and make note of what your full retirement age will be. All right. So as I mentioned, full retirement age is the age at which you claim full unreduced Social Security benefits. On the earlier slide, we saw the maximum person who turned 62 this year. They would earn $3,262 PIA. That's the amount you would receive if you file for Social Security at your full retirement age. So claiming Social Security before your full retirement age will cause your benefit to be reduced. And this is what a lot of people end up running into when they start to claim early. They do allow you to claim as early as 62. And if you do that, then understand your benefits will be reduced. On the other end of that, if you wait for collect after your full retirement age, you actually get a bonus. And we'll talk about that in a second as well. It doesn't matter to the Social Security Administration when people file or what type of credit you may get, bonus or the reduction, but it is very important to every individual. And so when you file determines your permanent monthly benefit. If you live longer than average, or if there's even a chance you might live longer than average, you'd be better off filing later and collecting a higher benefit, even if it means waiting a few more years for your checks to start. So let's talk a little bit more about this. Now, remember I said that your primary insurance amount, or PIA, is the benefit you will receive at full retirement age. So what happens if you apply for Social Security before full retirement age? Well, like I said, your benefit will be reduced. And as you can see by the chart here, if your full retirement age is 66 and you apply at 62, you'll receive a 75% of your PIA. 63, it's 80%, and so on. If your full retirement age is 67 and you apply at 62, you'll receive 70% of your PIA. These amounts are actually prorated monthly, so you can apply anytime after that. It doesn't have to be exactly on your birthday. They will credit it on a monthly basis after your 62nd birthday. So, and they've already got these numbers worked out. If you apply for Social Security after your full retirement age, you will earn a delayed credit of 8% for each year you delay it. So if your full retirement age is 66 and you apply at 67, your benefit will be 108%. If at 68, you collect Social Security, it'll be 116%, and so on. You can't receive any more credits after 70. So it's always best, when you turn 70 to take your Social Security, because there's no reason, there's no bonus for you delaying it. And I'll leave that up for a second. You guys take a look at that. All right, let's talk about cost of living adjustments, or COLAs. So I just mentioned that the age at which you claim your Social Security determines your permanent monthly benefit. However, in any year that there's inflation, your benefit will get a cost of living adjustment. Cost of living adjustment this year was 1.3%, but historically, the COLAs have varied widely. And on average, the 75 years they've been given COLAs, the average amount they give is 2.4%. Now, the COLA is applied to your benefit amount. The higher the benefit, of course, the higher the COLA will be, and it applies to benefits you haven't claimed yet. Once your PIA is calculated at 62, it'll rise each year with the cost of living adjustment, even if you're delaying until age 70. Now, I want you to understand that with this, you don't start receiving the COLA benefit until you are 62 years old. If you're 60 years old, 59 years old, and they're giving out cost of living adjustments, that will not apply to your Social Security benefit. But the second you are eligible to take Social Security, age 62, every year, even if you're pushing it off, and they're giving, if you're not collecting, like let's use this year for example, you were delaying your Social Security payment, and they gave out a 1.3 COLA adjustment, that's added now to your bottom line. So that goes into the monthly benefit that you'll get, even though you're not collecting. And it'll keep going up until you start to withdraw your Social Security benefits. All right, so a couple of key things to remember. The when to apply question is very complex and really requires a customized analysis. But a couple of things you need to remember. If you apply early, your benefit starts out at some fraction of your PIA, 75 or 80% or whatever, and remains at that percentage for the rest of your life. It will never get up to 100% when you reach full retirement age. COLAs magnify the impact of early or delayed claiming because the annual cost of living adjustment is applied to either the lower or the higher amount. When to apply questions impact survivor benefits as well. If the higher earning spouse maximizes his benefits by delaying to age 70, the higher benefit will transfer over to the lower earning spouse at death, and we'll cover this shortly. And of course, you'll need to take into account just your overall retirement picture. And I always talk about this. When it comes to Social Security, you want to look at it as a tool in a bucket in your overall retirement planning. Take into account your health status. Does your family have high life expectancy? What are going to be your income needs? What are your other retirement plans, when deciding to claim Social Security? So you want to look at all of those things before you decide to pull the trigger on Social Security. So when I usually meet with somebody about a Social Security analysis, I usually have them start here, and that's looking at your Social Security benefits. Back in the day, I think they used to send the actual green and white statements, and some of you who are a little older, I remember getting them, in the mail every year, and it would have your Social Security benefits, what they are based on your working history now and what they would be projected to be. So everybody who I ever sit down with to do a Social Security analysis, I usually start them at the socialsecurity.gov website. And if you've never created a statement, they do mail statements out now, but I really want to say it's every 5 years. They're really trying to produce paper, so they're not mailing them out. They want you to go online, and it's very easy to do. It's live information, and it's all up to date based on your whole working history. So if you've never created an account at, for Social Security, website, simple, socialsecurity.gov/my account. That'll allow you to register, and it'll pull in all of your working history. If you want to play around with calculators or you want to get an estimate of your retirement benefits, you can do it right out of that same website. So I'll give you a moment to write those down. All right. So basic rule number 2. Your spouse may be able to get a benefit based on your earnings. Before we discuss the spousal rules, I want to make a quick clarification. Back in 1939, the spousal benefits were originally created to give non-working wives a small benefit based on their husband's work record. But Social Security is gender neutral. Husbands now can claim off their spousal benefits too. And now that same-sex marriages are legal in all states, either spouse, regardless of gender, may be able to claim a spousal benefit. More important is combining the two incomes to work best for the family. What you want to do is make sure that both spouses can get paid off each other's income if that is something that's doable in the marriage. So here are the spousal benefits. The spousal benefit equals 50% of the worker's PIA. If the spouse applies for it at full retirement age, the primary worker must have filed his benefit. So you at 62 or whatever age, you have to be eligible to file the primary worker, and he must file the benefits. That's the rule. So in order for, let's say, Jill, for this illustration, to claim her spousal benefits based on Jack's work record, Jack must have filed his own Social Security benefits. This rule comes into play when we talk about claiming strategies, and it can trip you up if you're not careful. Spouse must be 62 years old for a spousal benefit. That's another rule. If the spouse claims a spousal benefit at 62, the benefit will be reduced, as we'll see in a moment. So spousal benefits do not earn delayed credits after 66. The most the spouse can ever get is 50% of the PIA. And finally, for most part, you can only get a spousal benefit if it's greater than the available benefit of your own record. And we'll talk about this in a second. That is, if 50% of your spouse's PIA is higher than your own, there's an exception to this rule, but it's complicated. So I'm going to circle back to that in a moment. But first, let's talk about how these benefits are calculated. So let's go back to Jack and Jill. And the spousal benefit is 50% of the worker's PIA if she applies for it at her full retirement age. So Jack's PIA, for sake of this illustration, is $2,000, and Jill's PIA is $800. If Jill applies for Social Security at her full retirement age, her benefit will equal 50% of Jack's PIA, or $1,000. This is $200 more than her benefit based on her own work record. So what if the lower earning spouse's PIA is more than half of the other spouse's PIA? So saying that Jill earns a little more, in that case, she may not receive the benefit. She would just be paid her own benefit as well. All right, now let's talk about this exception. In our example, we're looking at Jack. Let's say he was born in 1953 or earlier. And some of you may remember this rule. It went away in 2015. You could be able to file a restricted application for his spouse's benefit and receive 50% of Jill's PIA while his own benefit builds delayed credits to age 70. This strategy can give a couple thousands, tens of thousands of dollars in extra spousal benefits, and we consider it a loophole, like I said, which they closed in the Budget Act of 2015. But it's being phased back in, and people are being grandfathered in. So people who were 62 or older at the end of 2015, you were grandfathered in. And so if you're eligible for this rule, you can still go back and apply and receive the benefits. All right. So let's look at a maximization strategy for spousal planning. So regardless of which rule you fall under, the key to maximizing these benefits for married couples is to coordinate the two benefits. And this is what we found. When both spouses have relatively high PIAs, that is, the lower earning spouse PIA is more than half of the higher earning spouse's PIA, it pays for both spouses to claim their respective benefits at age 70 to get the maximum delayed credits. Our calculators show that if both spouses have average or longer than life expectancies, this will maximize benefits for both of them in their lifetime. And I'll show you a little bit more in a report, in some of the scenarios in the reports that we print out. So it may be possible for one spouse to receive spousal benefits while his or her benefits build delayed credit. Again, this is the exception, not the rule. You have to be been 62 at the end of 2015 to be able to claim that benefit at age 66 and receive 50% of your spouse's PIA while your own benefit builds delayed credit to 70. If you want to come and talk to me, by all means, we can figure this thing out and I can let you know if you actually do still apply for that credit. Like I said, you're going to be grandfathered in. So let's take a look at an example. Bob and Betty are married. They're both 59 and Bob's PIA is $3,000. Betty's is 1800. So let's assume, just for life expectancies, that the man, of course, is going to die early. So he's going to die at 85, Betty at 95. And I'm going to show you what our calculator says. So in the reports that we run when we do Social Security analysis, it actually gives us a report back with about 4 different scenarios and just claiming scenarios. And in this scenario that we just showed, scenario 1, they both claim as soon as possible at 62. Scenario 2, they each claim at full retirement age, which is 67 for both of them. And scenario 3, Betty claims early at 62. Bob claims later, at 70. And scenario 4, they both take the maximized benefit at 70 based on their life expectancy ages of 85 and 90, respectively. And if you look at the actual report in itself, it actually projects out what the lifetime payout would be if they ended up doing one of these strategies. So you get an idea. It's not exact. It does take into account, inflation. I am able to project, inflation. So we would put that in there as, COLA, because of inflation. We would be able to build that in there as well. So you get a close as possible look at what your payouts could be. So, and here's a graph showing the lifetime benefits for claiming each scenario. When I show couples this graph, they are really taken aback by the fact that if done properly and strategically, you could possibly earn up, $1 million, $2 million, in benefits over your lifetime. And that's what happens if you resist the urge to take it at 62. I've actually talked to some people and asked them why did they decide to take it early, and it was, well, just in case I die, like they were going to lose something. If your family, my grandfather lived to be 92 years old, so God willing, I'll live a nice long life, and I don't have any real health problems or anything like that, I would probably delay taking Social Security early to maximize our benefits, and it could actually pay out in the end. All right, so what if Bob died early? What if Bob died early? Let's take a look at the graph and see what Betty would be entitled to as far as the survival benefits. And again, this chart shows first year survival benefit for the long-lived spouse. In this case, of course, it's Betty. Men, for whatever reason, we die first. It's just the way it is. So she'll step into his benefit as her benefits will end. And you can see that the 2 scenarios that call for Bob to claim his benefit at 70 would give Betty the highest survivor benefit. And you see what, it's just about the same if they both, Bob claimed later, it'd work out better for Betty. So maybe Betty would be nudging him to kind of delay it if they didn't need the money up front. All right, so let's look at another example. So what if we changed her PIA to $800 a month? It's less than half of Bob's PIA, so she's entitled to the spousal benefit. In this next scenarios, we're going to show you what the payouts would look with Betty taking half of Bob's PIA. And so you see again, the PIA is 800, and the calculation shows us what she would receive if they claim early at 62 at full retirement age. And scenario 3 shows Betty claiming early and Bob claiming later. And then the maximum lifetime benefit scenario 4 has Betty claiming her benefits at full retirement age and Bob at 70. Her benefit is actually a combination of her own benefit again, and adding the spousal benefit, totaling 50% of Bob's PIA. And again, note the lifetime paid out benefits for each strategy. Do we have any questions or anything yet, Clarissa?
No, we don't.
All right, that's good. Must means one or two things. Either you guys are soaking this information up or you are thoroughly confused. Either way, you could reach out to me. All right, so let's look at the basic rule number 3. A divorced person may be able to get spousal benefits based on the ex-spouse's record. Now, we're going to get into this a little bit, but understand the rules for divorcees are similar to the ones for married couples. There are a few additional restrictions, and I always like to go through this because, you never want to talk to a person about possibly giving away more money to an ex-spouse. That never seems to go over quite as nice as you would want it to. But for the sake of this presentation, we'll go through the rules. A person can receive Social Security based on the ex's work record, providing the marriage lasted at least 10 years, and the divorced person claiming the benefit is currently unmarried. So that's important. These are two of the key rules. It doesn't matter when the marriage or divorce took place. If the marriage lasted 10 years, at least 10 years, even if the divorce occurred a long time ago, could have got married in your 20s and stayed married in early 30s and got divorced, that person is still able to claim Social Security based on the ex-spouse working record. The person claiming the benefit must be currently unmarried, and you could have had 2 or 3 marriages in between that first marriage. Say you got married 2 or 3 times. As long as it was 10 years and you are no longer married, you can still end up collecting on your ex-spouse's benefits. If you have more than one ex-spouse, and this is what I thought was just hilarious, you can, in each other of those marriages lasted at least 10 years, you can now pick and choose which benefit of the ex-spouse's benefit you want to choose from. The order of the marriage and divorces don't matter. So you can literally see which one you'd probably get paid out the highest from, and then select there. Granted, you would have to been married 3 times, and that's a little depressing when you think about it as well. All right, so there are a few more things to know about divorced spousal benefits. First, more than one ex-spouse can receive benefits on the same worker's record. So if your ex-spouse has been married a couple of times, all exes can claim on the divorced spouse's benefits, as long as the marriage lasted 10 years and the current person who was trying to claim spousal benefits is not married. Think of Johnny Carson. He was married 4 times, and 3 out of his 4 ex-wives all collected benefits on his Social Security. The benefits paid to your ex-spouse does not affect the worker's payout. And I think that's important to note, because sometimes people look at that as, either a pension or a retirement plan. If they're going to give to them, then they must be pulling it from somewhere. And, so they're going to take it from mine. They don't have to worry about that. It doesn't affect your payout benefit at all. For the claiming spouse, you don't even need to know your ex-spouse's whereabouts, only enough identifying information so Social Security can look them up and get their records. You'll need to provide documentation of showing the dates you were married and divorced. But other than that, you don't even need to know where they are. You just need to submit to them that information, and you'll be able to claim their benefits. If you are receiving a divorced spouse's benefits and you remarry, your divorced spouse benefits will stop. However, you may then be eligible, you married again, for your new spouse's benefits, again, if you have been married 10 years and you're not remarried when you go to file for these benefits. So that covers divorce. Now let's move on to another important rule. And this rule can get down in the weeds. And so I want to try to stay out of the weeds as much as possible, just because it can get, like I said, very complicated when we start looking at survivor benefits. So let's discuss who can get survivor benefits. In order for a surviving spouse to receive survivor benefits, the marriage must have lasted at least 9 months. In the exception, the only exception is an accident. To start the benefits, the survivor must be at least 60 years old or 50 if they're disabled. However, if the widow or widower applies before full retirement age, the benefit will be reduced as it is for the regular retirement benefits. Some of the same principles do go into deciding when applying for regular retirement benefits, also apply to survivor benefits. If you remarry, again, before age 60, you will not be able to receive a spousal benefit. So marrying has a lot to do with claiming ex-spouses or deceased spouses benefits. So you want to make sure you know that before 60. If you remarry after 60, you still will be able to claim your ex-spouse's benefits. So if both spouses are receiving benefits and one spouse has died, the other spouse may switch to the higher benefit. Let's take a look at this example of Julie and Joe. And for just to even things out, Julie is the high earner here. So they both are over full retirement age, and currently receiving Social Security benefits. Julie's benefits is $2,000 and Joe's is $1,200 a month. If Julie dies, Joe's benefit will stop and he will start receiving her $2,000. One of the things to really make note of about survival planning is the loss of one benefit. Most times, widows or widowers need at least 2/3 of the amount of income they were receiving as a couple. So it's important to plan the loss for the loss of one spouse's Social Security benefit. This, again, even though it's often the higher benefit that will be retained, the death of the spouse means the loss of one Social Security paycheck. So you need to make sure that you understand that as well and make note at the very least and plan around it. So you can find ways to supplement that lost income. Again, note that if Julie had maximized her benefits by filing at 70, say her benefit was $2,600 at age 70 with the additional delayed credits, Joe's survivor benefits would have been $2,600 and not $2,000. So let's look at some strategies for widows and widowers. All right, so let's say your spouse died either before or after starting your Social Security benefits, or maybe you were married for 10 years, divorced, and your ex-spouse has died. Is there anything you can do to coordinate your survivor benefit with your own retirement benefit to maximize your income benefits? Short answer is yes. You can start with one benefit and switch to the other one. The rule here is always take the higher benefit last. If the survivor benefit is higher, start with your own retirement benefit at 62 and switch your survivor benefit at full retirement age. If your benefit is higher, start your survivor benefit as early as 60 and switch to your retirement at 70. This will allow you to get the delayed credits and switch over at your full retirement age. All right, so let's look at basic rule number 5. And, we've talked about the disadvantages of claiming in terms of actual reduction, but there's another problem and one that might make early claiming totally mute. And this is one, again, that you need to put into your overall retirement and financial Social Security planning. If you are going to continue to work, claiming your benefits early, could work against you. And they do this by what's called the earnings test. So let's take a look at that. If you apply before you turn full retirement age and you earn more than $18,960 this year, $1 in every benefit will be withheld for every $2 you earn over $18,240. To avoid the earning test entirely, look, just wait until your full retirement age. I call this the Dana Barker syndrome. That's my stepfather. He ended up claiming at 62 and until 65 ended up paying back $1 for every dollar he earned. And I think at the time when he actually started taking Social Security, I think it was 14.5 or something like that. But everything, which is literally poverty. So they want you, if you're going to take your Social Security early, they want you to be around the poverty level to do that. So let's look at some little known rules about the earnings test. It applies to every kind of benefit, retirement, spousal, and survivor. It could even call your spousal benefits to be withheld. Let's take a look at John and Jane. They're both 62, and Jane is getting the spousal benefit of John's record, and John goes back to work. Then Jane's spousal benefit will be withheld. Again, just to avoid the earnings test at all, if you are going to continue to work after you turn 62, it is best just to wait until your full retirement age before you claim Social Security. All right, so let's look at the last basic rule. And I think, honestly, it's probably the most important rule. And this is something a lot of people do not know. Your Social Security could be subject to taxation. And not going to spend a great deal of time with this. I'm just going to give you the numbers, but because there's absolutely nothing you can do about it. If you do not plan wisely, there's nothing you can do about the taxes once you start taking money out of your Social Security. So let's look at the graph. So the table shows the taxation of Social Security benefits based on various income levels. Now, in this case, we're going to talk about provisional income, which includes your adjusted gross income plus 1/2 of the Social Security benefit, plus any taxes and interest. If provisional income is under 32,000 for a married couple. Think about that. If your provisional income this year is under $32,000 for a married couple, no benefits are subject to tax. Can you live off $32,000 for a year? Married, think about that. If the provisional income is between 32,000 and 44,000, then up to 50% of a married couple's benefits are subject to tax. If your income is over 44%, up to 85% of your Social Security benefits can be taxed. The threshold for singles are, 25,000 and 34,000. And in the case, if you're married, filing separately and living with a spouse, I don't know why you would do that at that age, but to each his own. 85% of the Social Security is taxable, regardless of your income level. The important thing to remember here is that up to 85% of your Social Security benefit may be subject to tax, depending on how much other income you have coming in. It's always good to take that into consideration as a part of your overall retirement plan. What money do you have to start taking that's been tax deferred in your 401k account? Maybe you have a traditional IRA. Maybe you have stocks. Maybe you have mutual funds. Maybe you sell your house and you end up having a capital gains from the sale of the house. All of those things are considerable provisional income, and they could have your Social Security benefits taxed up to 85%, which really, in itself wipes it out. So that's the basics of Social Security. Again, just wanted to cover the basics to give you the need to know information so you can start the process in deciding which strategy is best for you. If you have questions, you may still have questions. When should you apply? What will you do if you keep working? What can you do if you've already applied? How much will your benefit be? What do you do next? Get in touch with us. Clarissa hopefully put the meeting calendar invite in the chat box, and you can set up an appointment there, and I'll talk to you about your particular situation. Social Security shouldn't be guesswork, and we help take the guesswork out of it for you. And if you want to get in contact with me via phone, email, there is our information, or you could go to the website, dreambuilder-ri.com. It's important that you put the -ri.com in it, and you can reach out to us there, and we can conduct our free consult for Social Security analysis, tax savings analysis, and a retirement planning overview. So that concludes our presentation. And do we have any questions? Looks like we have no questions in the chat. So with that, I want to thank you again on behalf of Dream Builders, Danny and Clarissa. We want to thank you guys for spending your lunch break with us. You want to get in touch with us, I gave you the information. By all means, reach out, and look to talk to you guys soon. All right. Have a great afternoon.